we are talking to you about your investment strategy, which I have kind of loosely termed distressed investing. Now, traditionally, or correct me if I'm wrong, most distressed investors get involved on the debt side of things and then working through the company as it works out, sometimes in bankruptcy court. But you attack this from an equities perspective, which one would think is pretty risky on the one hand, which makes it, of course, contrarian. And then secondly, the whole distressed cycle has kind of now been put on hold because of COVID largely. And they just, correct me if I'm wrong, but there just have not been all that many bankruptcies. Again, you don't deal with the actual bankruptcies, but put all that in there. And then also the fact that you focus on industrial companies where everybody else now is focused on tech and growth, or so it seems. And I thought that this would be a good opportunity to have you come on the podcast and discuss these things. So without me screwing things up anymore, why don't I kick it over to you and you tell us more specifically about your investing strategy?
All right. So what we do is we try to find companies that people think are going to go bankrupt, more or less. So we're very valuation driven. So more or less, I try to buy things at less than 3 times pre-tax free cash flow on the equity. So why 3 times? 3 times is good because if a lot of people think cheap's 7 or 10 times, but ideally, most of the companies I buy have a lot of debt on them, or they're in some kind of situation where people there's a refinancing cliff or something coming forward. So and a lot of the situations are actually deleveragings where they're using all their free cash flow to pay down the debt. So why 3 times? 3 times is interesting because they can start buying back shares. Mm-hmm. And if you have a good capital allocator, they can be paying down debt. And then if they feel very comfortable that the maturity might be in 5 or 10 years, or not 5 or 10 years, 5 or 7 years, then they can stop paying down debt if the stock doesn't move, and they can buy back a third of the shares with their free cash flow. So ideally, you want to have it below that sort of multiple, at least I think so. So it can have a meaningful impact. Whereas if it was trading at 10 times earnings, 10% of the shares is not really a game changer. At least I don't think so, in terms of eliminating the share count. So more or less what we do is we try to find these companies that are going through some kind of situation, whether it could be a good co, bad co, or just some kind of turnaround where there's a good company that's growing inside of a legacy bad company that's declining in revenues, that the people don't understand that the good company is going to become the new company going forward. So if we can buy things that actually have a growth aspect to them, that are trading at extremely low multiples, so sub 3 times pre-tax free cash flow, then it generally works out. I mean, there's some risk there. I mean, some people will be scared to touch things that are trading at that have a lot of debt, but there's some key nuances that you need to sort of pay attention to.